Hi guys, welcome back to CashBright. In this our second video in our Journey to Financial Independence series, we will be discussing stock prices. For anyone looking to become financially independent, understanding stocks and what is going on in terms of what is driving their price is fundamental. Participating in the stock market is to deal in risk and uncertainty, in exchange for financial reward. In general, the higher the risk, the greater the reward, and vice versa. The price of a stock is in part a reflection of the perceived cost of taking on the risk of owning it. But it's also true that stock prices move in mysterious ways, and market analysts are often at a loss to explain why. So in this video, we'll be looking at the basic mechanisms underpinning stock prices, common factors affecting their price, and why price trends can be misleading. Number 1. Basics of stock prices. Now the first thing to understand is that the stock market is a two-sided market. This means that both buyers and sellers meet to exchange products or services through an intermediary. This interaction creates bids for selling and asks for buying. The relevant intermediary in the case of the stock market is the market maker, also known as a market specialist. This is commonly a brokerage house, but may also be an individual. Their job is to keep the market moving by buying and selling stocks at quoted prices. The market maker sets the ask price, that is the price at which you can buy a given stock, and the bid price, the amount at which you can sell a stock, all based on demand and supply. Now, the market maker clearly engages in a level of risk just by holding the stock, and so the way they are compensated for this is through what's known as the spread. The spread is simply the difference between the bid and ask price. For example, suppose you wanted to buy a stock and you instructed your broker accordingly. The market maker sets an ask price, remember that's for buying, of $55 per stock, and a bid price, for selling, of $50. Like any middleman dealer, they want to make a profit, and so let's assume you proceed to buy the stock for $55. Assuming the market maker bought the stock itself at $50, the difference in $5 is kept as profit. Market makers help to keep the stock market going by always offering quoted bid and ask prices. Finally, it's useful to remember that in general, an increase in demand or a decrease in supply will cause prices of stocks to rise. Conversely, when it is demanded less or supplied more, that is, where there is a decrease in the equilibrium level of demand, or alternatively, an increase in the equilibrium level of supply, prices will fall. Number 2. Factors affecting stock prices. As previously mentioned, stock prices are determined by demand and supply. But this begs the question, what actually determines the level of demand and supply for a stock? Well, first, demand simply represents what a person is willing to pay for a given quantity of goods or services, and supply represents the price at which a person is willing to sell. Now, there are multiple demand side and supply side factors which may affect the price level of a given stock, and because human beings, and therefore markets, are known not to be rational, pinning down these factors can be an enormous challenge. The main factors, however, that tend to be attributed to price changes are as follows. Factor 1. General economic news. Standard indicators such as inflation, that is the general increase in the price level of an economy, unemployment figures, and economic growth tend to affect investor confidence in the market. This is because, of course, companies that issue stocks and pay dividends are susceptible to changes in the economy, such as increases in the cost of production, brought about, for example, by an increase in the rate of inflation. If an underlying company appears likely to struggle, its stock price is also likely to take a tumble. Factor 2. Fads and trends. If a company is lucky enough to make a product which, rather inexplicably, becomes the newest fad, then naturally investors will see this and buy up more of its stock. Often, optimism in a new trend can create bubbles in the market, like back in the 1990s when many people were excitedly buying up stock in technology companies, only for the bubble to eventually burst in the early 2000s. Factor 3. Interest rate changes. Increases in interest rates generally cause stock prices to decrease, and vice versa. This is all because interest rate rises are designed to apply a kind of brake to an economy, all by making spending and borrowing less attractive. However, much depends on the circumstances. For example, where inflation is perceived by the public to be running wild in a country, an announcement of an interest rate rise may actually boost investor confidence and thereby also cause an increase in stock prices. Factor 4. Performance of other securities. Now, as you would expect, investors shop around and they compare the opportunity cost of investing in stocks in relation to, say, putting more of their money into bonds. If bonds are offering attractive returns, investors may choose to switch to this less risky type of security, thereby causing demand and prices for stocks to fall. Number 3. Trends in stock prices can be misleading. There's a difference between the price of a stock, or anything for that matter, and its inherent value. Remember, the price is simply a reflection of demand and supply. That is, the price at which people are willing to buy and sell. This means that it's very common for stocks to be overvalued or even undervalued on the market. The same holds true for the overall trend of stock prices, represented by stock market index values. Sometimes stock prices rise despite the short to medium term negative economic outlook for companies and the wider economy. The reasons for this are often opaque, but I personally believe it's driven by a mixture of hope and expectation that stocks will always trend upward in time. Whilst this may be true, it's not always the case for some stocks, and indeed, many investors are caught out when economic reality bites and companies are forced to either scale down or even file for bankruptcy. Overall, prices are useful gauges for market sentiment, but they should always be treated with a level of suspicion when it comes to deciding on your own investment strategy. In the next video, we will be looking at the kind of stocks investors look to buy and how you should go about choosing them. Thanks for watching. If you found this video to be helpful, please leave a like and don't forget to hit the subscribe button. And until the next time, stay sharp, stay hungry, and stay cash bright.